So the next deal structure is simple corporate basic. Very rarely used, or would I use this, but it'd be like basically a corporation and a personal come together to be on title. So offers may be written with just a single person or a company on the offer. So some lenders may not even want to lend to corporations mixed with personal, and pre-approval is really important in these cases, or they may just require personal guarantees from the main shareholder of the corporation. So say I'm, dealing with a money partner, and then the money partner is going to be in their personal name, and then I want to be on part of the joint venture agreement as a corporation, and then I might have to co-sign for my corporation, kind of a thing. For this type of structure where you really need a tax accountant and lawyer to be on your team, what if one of the investors or the money partners does not want to be on title for any reason? This can happen for all sorts of reasons. People just don't want to be on title. They don't want it. They just don't want that to show up in their credit reports or whatever. And in this case, the signed joint venture agreement is what protects all those who are involved in this transaction, in these types of transactions. And that can be registered post closing on a property with something that's called a caveat. So a lot of people have heard of a lien. Like say a contractor does work and doesn't get paid for a house, he'll put a lien on the property, and that goes next to the title or on the title. A caveat is very similar. It's like someone is making a claim on this property, and that's how joint ventures get registered. So they call it clouded. It renders the property title clouded, which means that it can't be sold without partners' approval. So that's the protection mechanism of a joint venture agreement. Very important when you're dealing with the investment, and not hard to do. It's just one of the steps you got to do. So the general rule with title and financing is that if your name is on the mortgage, then your name must also be on the title. That's just a flat rule. Generally speaking, banks will shy away from these types of deals as they want title to be less complicated, right? They just want, conventional banks like simplicity. The other thing is with capital gains issues, being the sole name on a title could be costly for the money partner if it's not done well. So the managing partner will in the accounting phase will divide up the revenues, the expenses, and the property ownership so that they're both equally sharing in the capital gains of the property if and when they sell. So with good tracking and integrity from the JV managing partner, that's not an issue. If you're the sole name on title, according to the Cabinet Revenue Agency, if that property is sold, like I said, you'd be on the hook for the full capital gains. And that's why the accounting needs to be done well every year. So you just separate and track everything, the beneficial ownership of everything on a year-to-year basis when you do your accounting. So I'll give an example. If a deal is owned 50-50 at tax time, each investor would only claim 50% of the revenues and 50% of the expenses. And that's the basics of that structure. It's doable, and sometimes it's the right way to go, but it's not as common.